Hey everyone, today we follow up my yield curve video with the safe haven video for those of you concerned about preserving your hard-earned capital when markets don't do well. Let's get into it. Hi, I'm Joe Macek, and unlike most financial YouTubers out there, I am a licensed investment advisor and portfolio manager for IA Private Wealth, and I've been helping guide and counsel Canadian investors for over 22 years. Welcome to my YouTube channel, Investing Made Simple, where you can find the most trusted information on building your net worth. I'm super excited to get into this video where we will go deep into finding out all we can about the popular so-called safe haven investments and hopefully give you some insight into what I feel are the best alternatives out there. But as always, before we get too deep into the video, I'd like to go through my usual disclaimer. And the long and the short of it is, before you make any decisions surrounding your money based on any video you see on YouTube, please take the time to consult with a fully licensed professional, or feel free to reach out to me on a one-on-one basis. My contact details are now provided in the description below. The other thing you need to do is completely crush that like button for the YouTube algorithm. Yeah, just sail over it. Leave a positive comment in the comments section below, as it really helps out my channel. And if you happen to like my content, I would be thrilled if you would just hit that subscribe button and darken that notification bell so you too can be notified when I upload such action-packed content such as my yield curve video and how to train your kids to be rich. Did I say action-packed? Yes. Action-packed. Okay, now back to our video. In my yield curve video, I went through all the reasons as to why that indicator of recession and subsequent market collapse was important. I also went through several reasons as to why going to cash wouldn't work, along with other assets that are touted as being defensive. But in reality, they are not. And for those of you who haven't seen that video, I would highly encourage you to watch it as a precursor to this one, as what I will say here will make a lot more sense. So in keeping with my previous video, I will walk through the more common so-called safe havens and see how they perform during market collapses, and then detail what I think is a better alternative and how they work. In addition to cash, which we know likely won't work, here are the most common safe havens described on the internet and how they perform. Finance Monthly, Money Crashers, and many other types of articles like this tend to spew out the same 4 to 6 safe haven assets. These are index funds, federal treasury ETFs and government bonds, utility stocks, real estate, and precious metals. These so-called safe haven assets haven't done very well when the markets decide they're going to collapse. Let's go through them one by one. Well, treasury ETFs and index funds, out of all the mentioned safe havens in this article, this one tends to hold up the strongest, but I still wouldn't personally classify it as a safe haven. Treasury and government bond ETFs will lose value as the Fed raises rates prior to the recession, as we have seen this year. The iShares US Treasury ETF is already down 7.69% for the year, and the Fed isn't done raising rates yet, along with the fact that we haven't seen the inversion. But as of this writing, I would argue it's close. It's highly likely this fund will be down worse by the time rate hikes stop, and the rate hikes usually don't stop until well after the yield curve has inverted. I've included a few charts here showing what happens to treasuries from the peak of the market, and it appears to do quite well. But remember, this is from the absolute apex of the market, which isn't very realistic. And I would argue that if you are going to preserve your capital prior to this apex, which is usually when the markets signal a recession is coming, you are likely to be pretty negative prior to the peak, and as you can see here from treasuries during this time frame, also showed signs of weakness before they recovered. So again, while it's my opinion that treasuries have probably done the best out of this group outside of cash in history, you cannot use treasury ETFs or government bonds to preserve your capital when it matters most. And I would say this so-called safe haven is not completely busted, but I wouldn't go so far as to call it a safe haven either. Let's move on to utilities. As we can see in this chart provided by CCM Market Model in the Great Recession, most utilities got utterly decimated. I mean, I don't think there's a single utility. Oh, wait, here we got one. New Jersey Resources here is the only one that lost 5%, but the average is down 30% in 2009. And they also got crushed here approximately by 20% in 2020, as we can see here in the Vanguard Utilities ETF. I think it's fairly safe to say without a doubt that this so-called safe haven is firmly busted. Real estate, well, I think we all know what happened to real estate in 2009, as I think this picture says it all. In 2008, real estate investment trusts fell about 37%, far more than utilities and treasuries, and that was just the calendar year. They fell a lot worse by the time March 2009 rolled around, as you can see in this chart. While I am a huge fan of holding real estate in portfolios as a so-called safe haven, I don't think I would put this asset class in the safe haven category. And finally, precious metals. A lot of people tout gold as a well-known, obvious safe haven. Well, let's just see how well it does. Gold prices and stocks, along with many other precious metals, get absolutely crushed along with almost everything else in a bear market, as you can see here from these charts. In fact, the only way that precious metals seem to appreciate is when the Federal Reserve decides that they're going to print a ton of money. And that would make sense, as gold and precious metals have always been regarded as an inflation hedge. So if you're looking for a safe haven from inflation, this could be something that you could invest in. However, as you can plainly see after the 2009 financial crisis, gold moved lower along with markets and then higher in conjunction with expansionary moves. But during recessions and market collapses, it collapses along with the rest of the market. The so-called safe haven of precious metals is out. So in review, Treasury ETFs, utilities, real estate, and precious metals, all of them touted to be as safe havens for your capital during a bear market, have been thoroughly busted or at least seriously called into question. Which leads us to the types of asset classes that I believe give you the best opportunity to move into when the yield curve inverts and we get that signal that things may not be so rosy. They also, for some silly reason, aren't ever listed as safe haven assets in most safe haven articles. Alternative assets, including private equity and hedge funds, specifically market neutral style hedge funds, are this asset class. Now, while we diversify clients in private equity and many types of alternatives, in today's video we will be focusing on one asset class, specifically market neutral style hedge funds in the liquid alternative space. Why? Well, while it is true that private equity in our discretionary portfolios is far less volatile as they don't really trade with the market, they're just kind of priced at net asset value on a regular basis, we won't be going into depth with them because they're investments for accredited investors only. More on that later. Some examples of these types of private equity are Avenue Living, Unison, 9 Point, Rise, and Centurion, to name a few. These are not meant to be recommendations, but I did put links to these types of funds in the description below. As you can see from a few of the fact sheets presented on their performance, these types of investment vehicles have just been valued at NAV and have appreciated steadily over time. They have extremely low volatility because of the fact that they don't trade on the market and are independently valued by third-party auditors as to their net asset value. Many of my viewers are not accredited investors, and you need to be an accredited investor to be able to invest in these. Unless, of course, you hire an investment advisor and portfolio manager and he or she becomes the accredited investor on your behalf. Now, I know what you were thinking. Why is it that only people who have a large net worth or a large income have access to these hedge funds? Well, not all hedge funds are created equal, and they are complex and sometimes a lot higher risk. So regulators say that if you have a large amount of wealth or income, you are able to take on higher risk of investing in hedge funds. Something happened in 2019 regarding these rules, as some hedge funds were deemed a lot lower risk and were made available to non-accredited investors. And I do want to touch on what happened in the mutual fund and ETF industry in Canada over the past few years. You see, the regulators were lobbied to create a structure whereby non-accredited investors could have access to these alternative style hedge fund investments without qualifying for accredited status. Enter liquid alternatives. These are fairly recent changes that happened to the market in Canada. And on the 3rd of January 2019, amendments to Canada's National Instrument 81-102 investment funds and to related national instruments made liquid alternative strategies previously only available to wealthy hedge fund investors, aka accredited investors, available to all Canadians. So now everyone has the ability to invest in products that can reduce volatility and risk while still generating a return through bear markets. And this is why we will focus on market neutral strategies, but specifically ones that have been made available to non-accredited investors via the liquid alternative route. How well do they accomplish this? Well, these next few charts, of course, are not to be taken as recommendations, but more of examples of how market neutral funds behave when markets collapse. And so for our examples, we will be looking at the market neutral funds from Picton Mahoney, AGF, and Desjardins. And these are examples of funds or ETFs that can be purchased, and all of them have different performance and characteristics associated with their strategies. But in short, these investments are designed to make money or hold your value regardless of market direction. They typically use a long-short strategy, which I will get into another video. But for today, we will walk through how these funds have performed during the last market collapse in March of 2020. And with Picton, I will show their actual hedge fund performance going back to 2008-2009. You will also notice the performance history on liquid alts is fairly short. And it makes sense, as a lot of these alternatives only started in 2019. Now we will start with Picton Mahoney, and I will have to show you their market neutral hedge fund, not their liquid alt. But their liquid alt is managed in the exact same manner. You can see right off the bat how little volatility they experience and how low the drawdowns are, especially during 2008 and 2009 and during 2020. And again, I don't think this is a fund you want to own if you believe the markets are going to be good, as it will underperform the markets in the long run. But as you can see, you can buy these types of funds well in advance of a market collapse and potentially earn a decent return with lower volatility if you believe there's trouble on the horizon. AGF Investments has a market neutral in BTAL, which seems to actually appreciate during bad times and depreciate during good times. You can see the performance of BTAL compared with the S&P 500 in this chart and see the divergence of returns. Desjardins also has a market neutral fund that has held its value nicely over the past 6 months, as seen in this chart here. Thanks to the rule changes in Canada and liquid alternatives, all investors now have access to these types of strategies. Now I have put links to these in the description below. However, these again are examples of strategies you can use, not recommendations to be followed. Please reach out to a fully licensed investment advisor and portfolio manager, or feel free to reach out to me on a one-on-one basis if you feel you have any further questions or want to find out more if these types of strategies are a fit for you. In closing, I really hope you've enjoyed this video, as it was a real fun one for me to do, and I hope this information has further educated you on the preserving nature of market neutral strategies. In my follow-up video to this one, I will be walking through how managers such as Picton Mahoney, AGF, and Desjardins structure their portfolios inside the ETFs to achieve such low volatility. Stay tuned for that. Once again, I want to thank you for joining me here today at Investing Made Simple, where you can find trusted information on how to build your net worth using all types of investments. Please hit that like button for the YouTube algorithm, as it really helps out my channel. And if you like my content and you want to be kept in the loop with all of my latest videos, I would be thrilled if you would just hit that subscribe button, leave a positive comment in the comments section below, and darken that notification bell. Until next time, this is Joe Macek for Investing Made Simple. See you soon.